Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group. And I'm Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what's going on in the markets?
Hey, thank you, Jeremy. Thanks for the listeners jumping on a call. It's great to be back on a call. So basically, last week, AI spending was the concern. It drove the market action. So we saw investors sharply repricing these hyperscalers, these stocks, and their tolerance for this great capital spending that they're employing. We also saw semiconductor stocks rebound. Energy was the top performing sector, where we saw Brent crude briefly exceeding about $100 per barrel amid the escalation geopolitics with the United States and Iran in terms of the tension. We saw some elevated refining margins supporting some energy stocks and helping the sector gain more than about 3% for the week. Consumer discretionary was the weakest sector. It fell about 5% or just over that. And higher energy prices impacted some broader markets. So we saw the rising oil prices contributing to some higher treasury yields across that curve. The U.S. dollar, that strengthened against the Japanese yen. We saw the U.S. and Japanese rate differentials drove currency markets. We saw a wide interest rate gap outweighed concerns about potential Bank of Japan's intervention. And the carry trades remained popular, supporting some dollar strength. The Fed rate hike expectations did increase a bit. I think they're putting it now at about a 1 in 3 chance of a July rate hike. And we saw the new U.S. trade policy announcement that came from President Trump, replacing the existing global 10% trade program with a new framework looking to charge anywhere from about 10 to 12.5%. We saw gold and crypto failed to hold their gains as we saw a stronger U.S. dollar and the higher interest rates offset those safe haven demands. Now, I think the key is this week, we're getting really deep into earnings. So 2 major catalysts are going to be dominating this week, and that's going to be a busy earnings week. We got Q2 earnings out. We're seeing some pretty robust earnings right now. They're, I think, beating or exceeding expectations by almost 70%. We'll see the Federal Reserve a July policy meeting coming out and their comments. But more than 1/3 of the S&P were reporting earnings. So we'll have Microsoft and Meta coming out on Wednesday, Apple and Amazon on Thursday. So really some tech heavy hitters coming out. We'll see the AI spending remain really key with investors. That'll be front of mind, in focus, if you might. And we'll have some broader economic insights. That'll be rolling out in the Fed decision. They'll have some comments. We're not expecting a rate hike. I know the slant to the market might be they are. I think it's going to be really in this situation more of a wait and see instead of just rolling out a rate hike. But we'll have to see what they do. And then geopolitical events, with the increased Iran-U.S. tensions, that's always going to cause some added volatility and risk in the market. Jeremy?
Gotcha, Graham. Well, I had a question for you. So, do you think that this tech heavy rotation out of tech, the rotation, do you think that's going to continue?
I think it can. I think it ran up so much, the anticipation of AI, but now the question is on that spend, that capital expenditure. Are they spending too much? Because we haven't seen really the profits and revenues. And a lot of these companies that are so cash flow positive are now going cash flow negative for the spend. So I think the appetite in the market is just not there. I think some other sectors like chips and semis and whatnot ran up a lot. And I think it's good old-fashioned rotation within the market sectors, which is healthy. You want to see a broadening out. So that's why we're seeing some of those more consumer staples kind of rise a bit where some of those techs are falling. So long story short, yeah, I think it could continue a little bit longer. It could get a little bit worse before it gets better. But there is a point where the other side gets unattractive, right? With valuations being too high, and the market will shift back. So keep in mind also for our viewers that we're moving into kind of a lackluster time of the year. Summer, fall, that's usually not the best time of the year for the market. So again, not surprised to see some volatility here.
Gotcha. Well, Graham, we always appreciate the information, expertise, and thank our listeners that check in with us every single week. And we look forward to seeing you next time. Have a great week.
Take care.